Imagine walking into the richest building in your city with no coins in your pocket. That would not be unusual, because nobody in the world has invented a coin. You are a merchant in southern Mesopotamia nearly 4,000 years ago. Your boat has arrived carrying timber, copper, and stone from lands beyond the river plain. Farmers want your materials. Workshops need them. The palace wants a share. But there is no printed price tag, no cash register, and no circular piece of metal guaranteed by a royal stamp. Instead, a scribe weighs silver on a balance. Another measures barley into standard containers. A clerk checks a clay tablet bearing names, numbers, and seals. It records what you delivered, what you owe, and what others owe you. Some goods enter a warehouse. Others never move at all, because one obligation can be cancelled against another. By sunset, you may have stored value, received credit, and settled a payment without touching anything that a modern person would recognize as currency. There is no bank sign above the door. Yet several pieces of banking are already happening inside. This is the puzzle hidden behind the first coins. Coinage appeared in Western Anatolia around the 7th century BCE, but organized societies had already spent thousands of years storing wealth, calculating balances, making loans, and transferring claims. The coin did not create finance. It made one part of finance easier to carry. Long before a ruler stamped metal, people had learned that money and coins were not the same thing. A coin is a standardized object. Money is a system for measuring value, making payments, storing purchasing power, and settling debts. If a society can perform those jobs with weighed silver, grain, and trusted records, it can have money without coinage. And if institutions can protect assets, maintain accounts, and extend credit, parts of banking can exist before anybody has a word for a bank. But calling an ancient temple a bank can also mislead us. A modern bank accepts deposits, lends much of that money to other customers, processes payments, and promises depositors that their balances remain available. Ancient temples, palaces, and merchant houses performed some of these functions, but rarely all of them in the same way. They were religious centers, governments, estates, workshops, and trading organizations, as well as places of finance. The first bank was not a single building waiting to be discovered under the sand. Banking emerged as separate economic problems were solved one by one. The first problem was storage. Agriculture creates wealth in bursts. Barley arrives at harvest, but households need food, seed, and wages throughout the year. A farmer cannot leave every sack in an open courtyard. Grain attracts insects, rodents, moisture, thieves, and hungry relatives. It must be dried, guarded, measured, and distributed before it spoils. Large institutions became good at doing this. Temples and palaces controlled land, received agricultural products, and managed workers, animals, and workshops. Their storerooms concentrated enormous quantities of grain, wool, oil, dates, metals, and finished goods. This was not a public savings account in the modern sense. Much of the property belonged to the institution or arrived as rent, tax, tribute, or an obligation. But concentration created financial possibilities. A household with 10 sacks can survive one season. An institution with thousands of sacks can plan across many households and many months. It can hold reserves, advance seed, feed workers before production is finished, and shift supplies from areas of surplus to areas of need. The warehouse turns time into something manageable. Grain received in autumn can fund labour in spring. Wool collected from shepherds can be issued to weavers before cloth exists. Silver acquired through trade can finance another journey before the previous cargo has been consumed. The building is doing more than storing objects. It is connecting production at different moments. That is one of the deepest functions of finance. Yet a warehouse creates a new difficulty. Once thousands of nearly identical measures of barley are mixed together, memory is no longer enough. Who supplied what? Which worker has already received a ration? How much copper did a merchant take? What must be returned after harvest? The solution was accounting. Some of the earliest writing in Mesopotamia appears in administrative records. Long before scribes wrote epics about kings and gods, they used signs and numbers to track commodities, workers, and obligations. Clay was abundant, cheap, and difficult to alter invisibly once it had dried. A tablet could outlive the conversation that created it. That changed the economics of trust. Without a record, a transaction depends on two memories and the balance of power between them. With a record, a third object enters the dispute. The tablet can name the commodity, quantity, date, and parties. Witnesses and cylinder seals can connect respected people to the agreement. A clay envelope can protect the text inside while repeating essential information outside. The writing is physically worthless compared with the silver it describes. But the record makes valuable promises enforceable. This was not yet a bank account on a screen. Tablets were often receipts, contracts, administrative lists, or evidence held in archives. They did not all circulate from hand to hand, like banknotes, and an entry did not automatically give every owner an instant right to withdraw from a common pool. Still, a crucial separation had begun. Value could remain in one place while information about value moved. That separation makes banking possible. The next problem was measurement. Before coins, silver was not absent. It simply arrived as rings, coils, bars, fragments, or pieces cut from larger objects. Payment required a balance and standardized weights. The word shekel originally referred to a unit of weight, not a minted coin. Larger units, such as the mina and talent, created a ladder for calculation. If a merchant owed 1 shekel of silver, he owed a measured weight. The metal did not need a king's portrait. It needed the correct mass and acceptable purity. This meant every serious payment carried costs that a coin would later reduce. The silver had to be produced, transported, inspected, weighed, and sometimes tested. Scales could be manipulated. Weights could be false. Metal could be mixed with cheaper material. Tiny differences multiplied across large transactions. Trusted institutions lowered these costs. A temple, palace, or established merchant house possessed standardized measures, trained scribes, and a reputation worth protecting. People were more willing to accept a calculation when the institution's weights, seals, and records stood behind it. The authority did not create the silver's scarcity. It created confidence in the measurement. Barley performed another part of the monetary work. In the Neo-Sumerian economy, both barley and silver served as standards of value and deferred payment. Administrative accounts could express goods through equivalencies. A shekel of silver could be related to a conventional quantity of barley, while oil, wool, fish, and labor could be valued through the same accounting system. This did not mean every shopper carried barley to every purchase. A unit of account can price a transaction even when a different object settles it. Modern people do this without noticing. A company can record a debt in dollars and discharge it through an electronic transfer. No paper dollars appear. Ancient accounts could similarly calculate value in silver or barley even when the final settlement involved goods, labor, or the cancellation of another claim. The unit existed most powerfully inside the ledger. That is why the invention of account money may be more important than the invention of the coin. A coin makes value portable. An account makes value abstract. Once obligations share a common measure, they can be compared. If a workshop owes wool to the temple owes rations to its workers, and a merchant owes silver for goods, the scribe can translate different activities into quantities that fit one administrative picture. The tablet becomes a map of claims. It tells the institution not only what it owns, but what the future is supposed to deliver. Credit grows naturally from that system because ancient production was full of delays. Seed had to be issued before harvest. Wool had to reach weavers before finished cloth could be returned. Merchants needed silver before caravans departed. Workers needed food before canals, walls, and boats were completed. An advance and a loan can look similar from the recipient's side. Value arrives now, while value or work returns later. The difference depends on who owns the production, who carries the risk, and what the record says. Temples, palaces, and private merchants all extended credit. A barley loan might be repaid after harvest. A silver loan could finance commerce. Contracts specified quantities, due dates, interest, witnesses, guarantors, and sometimes pledged property. The customary rates visible in many Mesopotamian records could be high, often 1/3 on barley and 1/5 on silver. Those numbers should not be dropped directly into a modern annual percentage calculator. Terms, timing, and actual practice varied, and some obligations were settled, rolled over, or forgiven under different conditions. But the rates reveal the lender's problem. Grain can spoil, harvests can fail, caravans can disappear, borrowers can lie, courts can be expensive, credit turned uncertain futures into present value, and interest placed a price on the uncertainty. The lender did not need coins. He needed surplus, information, and enforcement. The borrower did not need a bank card. He needed someone willing to believe that the future crop, cargo, or labor would be enough. Clay tablets preserved that belief in contractual form. One old Assyrian tablet from the early 2nd millennium BCE records a debt of 6 minas of silver, roughly 3 kilograms, owed by 2 men to a merchant named Ashur-idi. Part was due by one harvest and the remainder later. If payment was delayed, monthly interest would begin. The names of witnesses and impressions of seals supported the claim. No coin appears in the transaction. The debt is still precise. This is where the ancient archive begins to resemble the memory of a financial institution. A merchant household could preserve loan contracts, partnership accounts, receipts, and letters across years. The records told heirs which claims remained valuable and told courts why a payment was due. The archive allowed a business to survive beyond one conversation. That continuity is a hidden form of capital. A bag of silver can be stolen once. A well-organized network can produce profit repeatedly. The old Assyrian merchants show how sophisticated such networks could become before coinage. Merchants from the city of Ashur operated long-distance trade with Anatolia, especially through the commercial settlement at Kanesh. Tin and textiles moved toward Anatolia. Silver returned. Families and partners divided responsibilities across cities, separated by weeks of travel. One relative could raise capital at home. Another could accompany caravans. Another could sell goods abroad. Letters carried instructions, prices, warnings, and complaints. Contracts divided profits. Agents represented principals. Debts connected households across enormous distances. This was not a modern bank with a public counter. It was merchant finance built from family firms, partnerships, and enforceable records. Its most valuable asset was credibility. A merchant who always settled could command goods and silver beyond what he personally held. A merchant who broke promises could lose access to the network. Reputation increased purchasing power before the first credit score by nearly 4,000 years. The network also allowed settlement without transporting silver for every obligation. Suppose one merchant in Ashur owed silver to a partner in Kanesh, while another obligation ran in the opposite direction. If the parties accepted the records and agents involved, they could offset claims or arrange payment through connected households. Only the net balance needed to travel. Every piece of metal left at rest removed a danger. Caravans were slow and vulnerable. Guards, pack animals, food, and tolls added cost. A claim recorded and settled within the network could move purchasing power more cheaply than silver moved across the road. The ancient financial system was therefore partly physical and partly informational. Grain sat in storerooms. Silver rested in sealed containers. Tablets, letters, and trusted messengers connected the claims. This resembles modern banking, but one critical difference remains. The institutions did not necessarily take one customer's deposit and lend it to another in the systematic way associated with later deposit banking. Temples and palaces could accept valuables for safekeeping, grant loans from their own resources, and manage payments. Private merchants could hold assets and extend credit. Yet these activities should not automatically be combined into the modern picture of a bank funding a loan book with withdrawable public deposits. The distinction matters because lending deposited money changes the entire risk structure. If a warehouse merely guards your silver, your claim matches a specific asset. If an intermediary lends most of that silver to somebody else while promising that you can still withdraw it, one asset now supports two expectations: the borrower's use and the depositor's access. That transformation is powerful. It is also the source of bank runs. The earliest pre-coin institutions gave civilization accounting, custody, credit, and settlement, but they did not always bundle them into that particular balance sheet machine. Calling them bank-like is accurate. Calling them modern banks with clay checking accounts is not. Even custody itself was more complicated than placing treasure in a sacred room. Temples inspired confidence because they were durable, guarded, and backed by religious authority. Stealing from a god could carry consequences beyond ordinary theft. Their officials controlled records and access. Their estates had labor, land, and political influence. But sacred did not mean risk-free. Temples could be plundered in war. Officials could abuse power. Rulers could seize resources. Fires, floods, pests, and administrative mistakes could destroy wealth. Grain in a warehouse was not permanent, like an entry in a myth. It shrank, spoiled, and required constant work. Storage had a price. Workers built bins, moved sacks, cleaned rooms, and watched doors. Scribes counted inflows and outflows. Supervisors checked measures. The institution needed enough revenue and authority to make the system survive. Ancient banking functions grew inside large organizations, partly because only large organizations could afford that machinery. Scale reduced some costs and created others. One household could remember its own jars. A palace managing thousands of people needed bureaucracy. Bureaucracy looked wasteful until the alternative was losing track of an entire harvest. The scribe sat at the center of this economy. He did not simply write what others had decided. The categories available in the account shaped what the institution could see. Standard measures allowed quantities from different villages to be combined. Dates made obligations mature. Names connected property to people. Totals exposed shortages. Archives allowed this year's claim to survive into the next. In modern finance, software performs much of this work. Before coins, it was done by trained human beings pressing reeds into clay. Literacy, therefore, operated like a financial technology with limited access. Most people could not independently inspect every record. They depended on scribes, witnesses, seals, and institutional authority. The person controlling the archive controlled the official memory. That power could protect an honest borrower against a false accusation. It could also make an ordinary worker nearly helpless when the record was wrong. The system was efficient because trust was concentrated. It was unequal for the same reason. Temples and palaces did not merely observe the economy. They organized large parts of it. They collected resources, assigned labor, supported specialists, and directed trade. Much of what passed through their accounts was redistribution rather than voluntary retail exchange. A worker receiving barley rations was not necessarily withdrawing wages from a personal bank balance. A merchant delivering copper to a palace was not always selling into a free marketplace. Obligation, taxation, dependency, and command were woven together. This is another reason modern labels must be used carefully. Finance can exist without capitalism. Accounting can exist without bank accounts. Money can exist without coins. And a building can perform bank-like services while remaining primarily a temple, palace, or household. The economic achievement was not that ancient people secretly invented every modern institution. It was that they solved modern-looking coordination problems with completely different tools. Consider a city with 10,000 inhabitants and no coinage. Farmers produce barley at different times. Shepherds deliver wool. Fishermen supply food. Workshops consume raw materials. Merchants bring metals from regions where the city has no direct control. Officials collect dues. Laborers need regular rations. If every exchange requires immediate barter, the system jams. The fisherman may not want wool. The weaver may not need fish. The copper merchant may not want either. But if all three accept values expressed in barley or silver, their obligations can be recorded in one common language. Actual goods need move only where they are useful. The accounts handle the mismatch. The institution becomes a clearing point. Not necessarily because everyone holds a personal account, but because the center knows who delivered, who received, and which balance remains. The economic gain can be enormous. Transactions no longer depend on a double coincidence of wants. Production can be organized across seasons. Specialists can work without growing all their own food. Long distance merchants can supply materials absent from the local landscape. The city grows because accounting makes strangers partially legible. In a village, reputation lives in memory. In a city, reputation needs records. The seal helped turn identity into evidence. Cylinder seals rolled distinctive images across wet clay. Their impressions could authenticate containers, doors, envelopes, and documents. A seal was not a modern signature in every respect, but it connected authority to an object. This lowered the cost of verification. A warehouse keeper did not have to hear the original agreement. A later official could inspect the seal and archive. A merchant hundreds of miles away could recognize the authority attached to a message. Finance expands when promises become transferable through time and space. The clay tablet did not move at electronic speed. It did something more fundamental. It made the promise durable enough to travel. Across cities and centuries, the recurring tools are unmistakable. Standard measures, common units of account, written obligations, seals and witnesses, secure storage, loans against future production, networks able to settle value across distance. Together, they formed a financial infrastructure before coinage. So why invent coins at all? Because the pre-coin system was powerful but expensive at the edges. It worked best when people knew the measures, trusted the institution, and could access the record. A major merchant dealing with an established temple could weigh silver and verify a tablet. A soldier buying food in an unfamiliar market needed something faster. Every piece of uncoined metal raised questions. How heavy is it? How pure is it? Who cut it? Will the next seller accept it? A standardized stamped coin answered several questions at once. Its form announced an expected weight and fineness. The issuing authority stood behind it. Small pieces could circulate through anonymous transactions without a scribe rewriting the relationship each time. Coinage reduced verification costs. It made money more convenient at the market stall, in military pay, and across territories where personal trust was weak. But the coin also introduced new problems. It could be clipped, counterfeited, or debased. The issuing authority could change its content. Different cities produced different standards. Money changes became necessary because a stamped object was trusted only as far as the stamp's reputation reached. Coinage did not eliminate finance. It added a new layer. The old systems of accounts, credit, and storage remain necessary because even perfect coins cannot solve timing. A farmer still needs seed before harvest. A merchant still needs capital before the voyage. A government still spends before taxes arrive. A family still wants wealth protected from theft. Coins make settlement easier, but they do not make future income arrive sooner. That is the work of credit. Banking was assembled, not invented in one flash. Its parts appeared because each part attacked a different cost. Warehouses reduced the cost of physical insecurity. Standards reduced the cost of measurement. Writing reduced the cost of memory. Seals reduced the cost of authentication. Accounts reduced the need for immediate settlement. Credit reduced the cost of waiting. Merchant networks reduced the cost of distance. Coins reduced the cost of verifying metal in everyday exchange. The modern bank inherited all of them. Banking needed no mint. Return to the merchant who entered the city without coins. His timber can be valued in silver, even if no silver is paid immediately. His workers can receive barley measured from institutional stores. A tablet can record what the palace owes for the cargo. Another contract can direct part of that claim toward a debt he owes elsewhere. A merchant partner can advance resources for the next journey based on his history of settlement. Nothing about the transaction is simple. Weights must be honest. Measures must be consistent. Scribes must be competent. Seals must be recognized. Warehouses must be guarded. Courts must enforce obligations. Borrowers must expect to repay. The system works only when many forms of trust reinforce one another. That is why the earliest financial institutions grew beside political and religious power. A private promise could fail with the person who made it. A temple or palace appeared permanent. It owned land, employed officials, preserved archives, and claimed authority beyond one lifetime. Institutional continuity made long promises believable. Finance did not wait for coins to become political, nor did it wait for coins to become creative. It allowed cities to feed specialists, rulers to mobilize resources, merchants to cross continents, and producers to begin work before payment existed. It transformed future harvests into present activity and distant reputation into purchasing power. The cost was dependence on the institutions keeping the memory. If the measure was false, the borrower lost. If the archive disappeared, the claim weakened. If the ruler seized the storehouse, custody meant little. If harvest failed, the tablet could remain perfectly intact while the household collapsed. Banking before coins solved the problem of moving value through time. It did not remove the danger of the future. Coins later made money visible in a new way. A person could hold a stamped promise from an issuing authority in the palm of a hand. That visibility was so powerful that later generations began imagining money itself had started at the mint. The clay archives tell a different story. Long before money acquired a face, it had a memory. Long before it had milled edges, it had measures. Long before it rang on a counter, it existed as grain owed after harvest, silver due after a caravan, and rations promised for labor. The first banking systems did not begin with vaults full of coins. They began with the harder invention, convincing thousands of people that a measured quantity, a sealed tablet, and an enduring institution could make the future answerable to the past. Coins standardized the object. Banking standardized the promise. And the promise came first. That was the economics of banking before coins.